put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The $65 trillion secret they never wanted you to know. In the summer of 2008, while the world watched Lehman Brothers collapse on television screens, something far more dangerous was dying in the shadows. A parallel financial universe, larger than all the world's traditional banks combined, was hemorrhaging trillions of dollars in a silent implosion that almost no one understood. This wasn't happening in marble bank lobbies or regulated institutions. It was happening in the shadow banking system, a $65 trillion empire of money that existed in the cracks between laws, operating without depositors, without regulation, without anyone watching. And when it collapsed, it nearly took civilization with it. Tonight, we pull back the curtain on the most powerful financial system you've never heard of, the one that controls your economic fate, while remaining completely invisible. This is the true story of the shadow banks, the men who built them, and the dark machinery of wealth that governments still don't fully control. To understand the shadow banking system is to understand a fundamental truth about modern finance. The real money doesn't flow where you can see it. While ordinary people deposit paychecks into Chase or Bank of America, an entirely separate financial universe operates in parallel. One without branches, without federal insurance, without the rules that govern traditional banking. Shadow banks are institutions that act like banks but aren't technically banks. They're hedge funds, money market funds, investment banks, mortgage lenders, insurance companies, and special purpose vehicles with names designed to mean nothing to outsiders. By 2007, this shadow system had grown to hold more than $20 trillion in assets, dwarfing the $13 trillion held by traditional banks. And here's the terrifying part. It was all built on leverage so extreme, it would make a casino owner nervous. The architecture of shadow banking was elegant in its deception. Traditional banks take deposits and make loans, simple, regulated, boring. Shadow banks created a Byzantine network of short-term borrowing and long-term lending, moving money through a labyrinth of interconnected entities so complex that even the people running them couldn't track the full exposure. They took mortgages and sliced them into tranches, bundled them into securities, sold them to special purpose vehicles, which then borrowed against them to buy more securities, creating a hall of mirrors where the same debt was counted as an asset dozens of times over. It was financial alchemy, turning risk into AAA-rated gold through the magic of structured finance. And for 2 decades, it minted fortunes for everyone involved. The shadow banking empire wasn't built by accident. It was engineered by some of the most brilliant financial minds in history, men who saw profit in the spaces between regulations. At the center stood firms like Bear Stearns, Lehman Brothers, and most powerfully, the repo market dealers who orchestrated the daily flow of trillions. But the true genius, or villain, depending on your perspective, was Louis Ranieri of Salomon Brothers, the father of mortgage-backed securities. In the 1980s, Ranieri pioneered the process of bundling home mortgages into tradable securities, creating a machine that turned Main Street debt into Wall Street profit. He transformed housing loans from static assets on bank balance sheets into liquid securities that could be sliced, diced, and sold worldwide. It was revolutionary. It was catastrophic. The beauty of Ranieri's innovation was that it freed up bank capital. Banks could originate mortgages, sell them into the shadow system, and use the freed capital to write more loans, a perpetual motion machine of debt creation. The shadow banks buying these securities borrowed short-term money in the repo market to finance long-term assets, earning the spread between what they paid and what they earned. As long as the music kept playing, everyone made money. Ranieri himself reportedly earned over $50 million in a single year during the 1980s, a fortune built on the mathematics of securitization. But he was just the beginning. By the 2000s, shadow banking had evolved into something far more dangerous. Jimmy Cain's Bear Stearns was running on 35-to-1 leverage. For every dollar of actual capital, they were borrowing $35 to make bets. Dick Foold's Lehman Brothers had $700 billion in assets, supported by just $25 billion in equity, a precarious tower built on the assumption that housing prices could never fall nationwide. And the repo market, the overnight lending system that kept shadow banks liquid, was processing $4.5 trillion daily in transactions, dwarfing the money supply of most nations. These men weren't just running banks. They were operating leverage machines that transformed pennies into dollars through the dark magic of borrowed money. And they were completely unregulated. One corner of the shadow banking system seemed particularly safe: money market funds. For decades, ordinary investors parked cash in money market funds, thinking they were as safe as bank accounts. They paid slightly higher interest than savings accounts and maintained a stable $1 per share value, the financial equivalent of a mattress, but with interest. By 2008, Americans had placed $3.8 trillion into money market funds, treating them as cash equivalents. But here's what they didn't understand. Money market funds weren't insured by the FDIC. They were shadow banks, investing in commercial paper and short-term corporate debt. And their stability was just an illusion, maintained by careful management. That illusion shattered on September 16, 2008, when Reserve Primary Fund broke the buck. Reserve Primary Fund held $785 million in Lehman Brothers commercial paper. When Lehman collapsed on September 15th, that paper became worthless overnight. The fund's net asset value fell to 97 cents per share, 3 cents below the sacred dollar that had been maintained for 37 years across the entire money market industry. Panic erupted instantly. Investors yanked $300 billion from money market funds in 3 days. A bank run on institutions that held the short-term financing for every major corporation in America. General Electric couldn't roll over its commercial paper. Caterpillar faced a cash crunch. The entire corporate financing system, the machinery that paid payroll, bought inventory, funded operations, was seizing up in real time. And here's the truly chilling part. The Federal Reserve had no legal authority to intervene because money market funds weren't banks. The shadow system was collapsing beyond the reach of regulators, pulling the real economy into the abyss with it. Ben Bernanke would later call those September days the moment when we came very close to Depression 2.0. While money market funds grabbed headlines, the real catastrophe was happening in the repo market, the overnight lending system that was the central nervous system of shadow banking. The repo market is where financial institutions borrow cash by pledging securities as collateral, with an agreement to repurchase those securities the next day at a slightly higher price. It's supposed to be the safest transaction in finance. You give me treasury bonds worth $100 million. I give you $98 million in cash overnight. And tomorrow you buy back your bonds for $98.01 million. The haircut, the difference between the collateral value and the loan amount, is supposed to protect the lender. But in 2008, the repo market revealed a fatal flaw. When no one trusts the collateral, the entire system stops. Bear Stearns died in the repo market. The investment bank was borrowing $50 billion nightly in the repo market to fund its operations, rolling over overnight loans every single day to stay alive. On March 10, 2008, Bear had $18 billion in cash and was confident it could weather any storm. Then the whispers started. Hedge funds questioned whether Bear's mortgage-backed securities were really worth what Bear claimed. Repo lenders started demanding larger haircuts. Instead of lending $98 against $100 in collateral, they'd only lend $90, then $80, then they stopped lending altogether. Within 5 days, Bear Stearns burned through $18 billion in cash, trying to meet margin calls and fund redemptions. On March 16th, CEO Alan Schwartz sold the 85-year-old firm to JP Morgan for $2 per share, down from $170 just a year earlier. 10,000 employees lost their jobs, shareholders lost $30 billion, and the shadow banking system learned a terrifying lesson. Liquidity can vanish in hours when confidence breaks. Lehman Brothers watched Bear's collapse and thought they were smarter. CEO Dick Fuld spent the summer of 2008 trying to raise capital, convince markets of Lehman's strength, and wait for government rescue that he assumed would come. It didn't. On September 10th, Lehman announced a $3.9 billion quarterly loss. Repo lenders fled immediately. By September 12th, Lehman's repo borrowings had collapsed from $200 billion to nearly zero. Without overnight funding, Lehman couldn't pay its obligations. Without liquidity, it couldn't sell assets fast enough to raise cash. On September 15th, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history, at $639 billion in assets. And the repo market, the invisible engine of shadow banking, ground to a complete halt. The real poison in the shadow banking system wasn't just leverage. It was complexity deliberately designed to obscure risk. At the height of the shadow banking era, Wall Street was churning out financial products so Byzantine that even the people creating them couldn't explain how they worked. Collateralized debt obligations, synthetic CDOs, CDO squared, credit default swaps. Each was a layer of abstraction built on another layer, creating financial instruments where the underlying risk was impossible to calculate. This wasn't an accident. It was the business model. Consider the journey of a single subprime mortgage originated in Las Vegas in 2006. A borrower with spotty credit and no down payment gets a $400,000 loan from a mortgage broker, who immediately sells it to Countrywide Financial. Countrywide bundles that mortgage with 5,000 others and sells the pool to a special purpose vehicle sponsored by Goldman Sachs. The SPV slices the pool into tranches, senior tranches rated AAA, mezzanine tranches rated BBB, and equity tranches with no rating. Hedge funds and shadow banks buy the AAA tranches, thinking they're bulletproof because rating agencies blessed them. But then another shadow bank takes the BBB tranches from 100 different mortgage pools, bundles them together, and creates a CDO squared, a security backed by securities backed by mortgages. Rating agencies, paid by the issuers, slap AAA ratings on 80% of these new tranches through mathematical models that assumed housing prices only go up. Insurance company AIG sells credit default swaps on these securities, essentially insurance policies guaranteeing their value, collecting premiums while assuming the policies would never pay out. By 2007, AIG's financial products division had written $500 billion in credit default swaps on mortgage securities, collecting billions in premiums while setting aside almost nothing in reserves. The head of AIGFP, Joseph Cassano, famously told investors in 2007, "It is hard for us, without being flippant, to even see a scenario within any kind of realm of reason that would see us losing $1 in any of those transactions." 6 months later, AIG required a $182 billion taxpayer bailout, the largest government rescue of a private company in history. Cassano walked away with $280 million in compensation over 8 years for building a time bomb inside the world's largest insurance company. His division's losses would eventually exceed $99 billion. But here's what almost nobody understands about the 2008 crisis. It never ended. The shadow banking system didn't die. It evolved. While Congress passed Dodd-Frank to regulate traditional banks more strictly, shadow banks simply adapted, moving activities into new legal structures beyond regulatory reach. Today, the shadow banking system is larger than ever, controlling an estimated $65 trillion in assets globally, roughly 13% larger than the traditional banking system, and equal to 75% of global GDP. The names have changed. Structured investment vehicles became collateralized loan obligations. Repo markets expanded into securities lending. Money market funds reformed, but still lack deposit insurance. But the fundamental structure remains identical. Massive leverage, short-term borrowing, long-term lending, and virtually no regulatory oversight. We didn't solve the problem. We moved it somewhere regulators can't see. And next time, there may not be governments large enough to intervene. Walk into any Federal Reserve conference today, and you'll hear economists discuss the non-bank financial intermediation sector in carefully sanitized language. Shadow banking has been rebranded, but its essential nature persists. Private equity firms now manage $7 trillion in assets, using leverage to buy companies, load them with debt, extract fees, and sell, repeating the cycle without meaningful oversight. Collateralized loan obligations, the post-crisis version of CDOs, have grown to a $1.4 trillion market, bundling risky corporate loans into securities with the same rating agency magic that failed in 2008. And the repo market, which nearly destroyed the financial system in 2008, now processes $4.7 trillion daily, more than before the crisis. The Federal Reserve has become the hidden support system keeping shadow banking alive. When repo markets seized up in September 2019, long before COVID, the Fed injected $75 billion overnight to keep the system functioning, eventually expanding to $120 billion daily. No bank was failing. The shadow banking system simply ran out of cash for routine overnight funding. The Fed stepped in not because it wanted to, but because letting the repo market collapse would crater the entire financial system. Shadow banks are now too big to fail, by another name, sustained by implicit government guarantees, while remaining officially outside regulatory perimeters. It's the worst of both worlds. Private profits during booms, socialized losses during crashes, and a system even larger and more leveraged than the one that collapsed in 2008. At its core, shadow banking exists for one reason. Leverage is addictive and profitable until it isn't. Traditional banks are limited by capital requirements. They can lend roughly $10 to $12 for every dollar of capital they hold. Shadow banks face no such constraints. Hedge funds routinely run 20 to 1 leverage. Private equity firms use 6 to 1 leverage on top of portfolio company debt, creating 15 to 1 effective leverage. Even safe money market funds operate with zero capital buffer, relying entirely on asset quality and liquidity. This leverage amplifies returns spectacularly when markets rise, turning 8% returns into 80% when you're levered 10 to 1. But it also amplifies losses, turning small declines into complete wipeouts. The mathematics are seductive. If you can borrow money at 2% and invest it at 5%, you're earning a 3% spread. Lever that 10 to 1, and you're earning 30% on your capital. Lever it 30 to 1 like Lehman did, and you're earning 90% returns. Until the assets decline 3.3%, and your entire capital is wiped out. Shadow banks live on this knife's edge perpetually, borrowing short to lend long, betting that liquidity will always be available at yesterday's prices. When that bet fails, collapse happens in hours, not months. And because shadow banks are interconnected through derivatives, repo agreements, and shared counterparties, one failure cascades instantly through the entire system. It's not a bug, it's the architecture. The genius of shadow banking, from a profit perspective, is that it operates in legal gray zones specifically designed to avoid regulation. Money market funds aren't banks, so they don't need FDIC insurance or Federal Reserve oversight. Hedge funds aren't mutual funds, so they escape SEC regulation by limiting investors to wealthy institutions and individuals. Private equity firms aren't depository institutions, so they face minimal disclosure requirements despite controlling trillions and impacting millions of jobs. Special purpose vehicles are domiciled in Delaware or Cayman Islands, existing solely on paper, with no employees, no offices, and no oversight beyond their sponsor banks, which themselves are regulated holding companies carefully structured to keep risky activities in unregulated subsidiaries. After 2008, regulators tried to close these loopholes. The Financial Stability Oversight Council was created to monitor systemic risk in non-bank financial institutions. Money market funds were required to hold small liquidity buffers and implement redemption fees during crises. Banks faced stricter capital requirements and stress tests. But shadow banks simply evolved. When new regulations made repo transactions more expensive for banks, the activity moved to hedge funds and asset managers operating outside regulatory perimeters. When money market reforms made funds less attractive, assets flowed into exchange-traded funds and ultra-short bond funds with similar risks but different legal structures. It's regulatory whack-a-mole. Push risk down in one place and it bulges up somewhere else, always migrating to wherever supervision is weakest. Treasury Secretary Janet Yellen admitted this reality in 2021. The regulatory perimeter has not kept pace with developments in the financial system. Translation: shadow banks are winning the regulatory arbitrage game, and regulators know it. The Financial Stability Board estimates that shadow banking now represents 50% of total financial system assets globally, meaning half of all financial activity happens outside the regulated banking sector. In some jurisdictions like the Cayman Islands and Ireland, shadow banking assets exceed 1,000% of GDP, hosting paper entities for the world's largest shadow banking operations. These aren't fringe activities. They're the core of modern finance, operating in a legal twilight that governments struggle to even map, let alone control. The terrifying question isn't whether shadow banking will cause another crisis. It's when and how big. The system today carries more leverage, more complexity, and more interconnection than in 2008, but with even less transparency. Collateralized loan obligations are bundling leveraged corporate loans made to companies with junk-level credit ratings. Exactly the same structure as the mortgage CDOs that destroyed the economy, just with corporate debt instead of housing debt. The CLO market has doubled since 2015 to $1.4 trillion, with many transactions so complex that even sophisticated investors can't calculate the underlying default risk. Rating agencies, the same ones that stamped AAA ratings on subprime mortgage securities, now rate 60% of CLO tranches as AAA, despite the underlying loans being made to companies with B credit ratings. It's the same movie with different actors. Private equity presents another systemic risk that regulators barely understand. PE firms have loaded portfolio companies with $1.4 trillion in debt, loans that get bundled into those CLOs and spread throughout the shadow banking system. When a recession hits and leveraged companies can't service their debt, losses will cascade through CLOs into pension funds, insurance companies, and money market funds that own CLO tranches. But unlike the 2008 crisis, where regulators could trace mortgage securities back to housing markets, the PE-CLO connection is deliberately opaque. Firms aren't required to disclose portfolio company performance. CLOS don't reveal which specific companies are in their collateral pools. When it unravels, regulators will be mapping the system in real time while it collapses. Exactly what happened with structured mortgage securities in 2008. And then there's the repo market, still the Achilles heel of shadow banking. The Federal Reserve has essentially become the lender of last resort for shadow banks, providing liquidity through its standing repo facility and actively intervening when markets seize up. This creates massive moral hazard. Shadow banks know the Fed will backstop repo markets during crises, encouraging even more leverage and risk-taking. But the Fed's balance sheet, while enormous at $7.7 trillion, isn't infinite. If a crisis hits that requires $5 trillion in emergency repo lending, not unthinkable, given that shadow banking now controls $65 trillion globally. The Fed may lack both legal authority and political support to intervene. And if the Fed doesn't intervene, the entire short-term funding market collapses, taking corporate payrolls, government financing, and everyday commercial transactions with it. We've built a financial system that requires constant Fed intervention to function, and we're pretending that's normal. Behind the trillions in shadow banking assets are real consequences for ordinary people who never consented to this system. When shadow banks collapsed in 2008, 8.7 million Americans lost their jobs. Unemployment peaked at 10%, the highest rate since the Great Depression. 10 million families lost their homes to foreclosure, not because they made bad decisions, but because a shadow banking system they didn't know existed made bets they didn't understand with leverage they never approved. The total wealth destruction exceeded $19 trillion in household net worth, evaporating retirement savings, college funds, and home equity built over decades. And the bailouts, the $700 billion TARP program, the $182 billion AIG rescue, the trillions in Fed emergency lending, were paid for by taxpayers who received nothing in return, while the executives who built the shadow banking casino walked away wealthy. Dick Fuld earned $484 million from Lehman Brothers between 2000 and 2008, keeping most of it even after the firm's collapse destroyed 25,000 jobs. Joseph Cassano left AIG with $280 million, despite losses that required the largest corporate bailout in history. The executives at Bear Stearns, Countrywide, Washington Mutual, they all kept their fortunes while their companies evaporated and their employees lost everything. Shadow banking privatized the profits and socialized the losses, transferring wealth from the middle class to financial elites through a crisis those elites created. Today, that dynamic continues, but more quietly. Private equity firms load companies with debt, extract hundreds of millions in fees, and leave businesses hollowed out or bankrupt. See Toys R Us, Sports Authority, Payless Shoes. Workers lose jobs and pensions, while PE partners earn billion-dollar fortunes, taxed at capital gains rates lower than what nurses and teachers pay. Money market funds offer slightly higher yields than bank accounts, attracting trillions from ordinary savers who don't realize they're uninsured and could lose everything in a crisis. Just like reserve primary fund investors in 2008. The shadow banking system operates as a wealth extraction mechanism, siphoning value from the productive economy into financial engineering that benefits a tiny elite while exposing everyone else to catastrophic risk. The shadow banking system reveals an uncomfortable truth about modern capitalism. The biggest money isn't made by building products or serving customers. It's made by exploiting regulatory gaps, amplifying leverage, and extracting value from complexity that obscures risk until it's too late. The men who built shadow banking weren't criminals in the traditional sense. They were opportunists who found legal loopholes and exploited them to their logical extremes. Louis Ranieri didn't break laws when he invented mortgage securitization. He created a legal framework that others would later abuse. Jimmy Kane and Dick Fuld didn't embezzle from Bear Stearns and Lehman Brothers. They used legal leverage to amplify returns until the leverage amplified losses and destroyed their firms. Joseph Cassano didn't commit fraud at AIG. He sold insurance policies that regulators didn't understand and rating agencies blessed as safe. This is the real darkness of shadow banking. It's a system where everyone follows the rules, maximizes shareholder value, and does exactly what they're incentivized to do. And the result is periodic financial catastrophes that destroy trillions in wealth and millions of lives. The system isn't broken. It's working exactly as designed, just with consequences that regulators refuse to acknowledge and politicians lack the will to prevent. Shadow banks exist because they're profitable, and they're profitable because they take risks that regulated banks cannot, using leverage that would be illegal in traditional banking, operating in legal structures specifically designed to avoid oversight. And when the next crisis hits, not if, but when, the pattern will repeat. Shadow banks will fail, liquidity will evaporate, repo markets will seize, money market funds will break the buck, and governments will face the choice between multi-trillion-dollar bailouts or economic collapse. The executives will keep their fortunes, the companies will vanish, the workers will lose their jobs, and taxpayers will absorb the losses. And 5 years later, shadow banking will be larger than ever, having evolved new structures to exploit whatever regulatory reforms were enacted in response to the crisis. It's a cycle we seem unable or unwilling to break, a perpetual motion machine of wealth extraction dressed up as financial innovation. Tonight, while you sleep, $4 trillion will move through the repo market, borrowed overnight, pledged against securities that may or may not be worth what the documents claim, rolled over tomorrow morning in transactions so routine that no one questions them anymore. Money market funds holding $3 trillion of American savings will invest in commercial paper and short-term corporate debt, providing cash to companies without any government guarantee protecting depositors if something goes wrong. Private equity firms will load another $1 billion of debt onto companies they own, extracting fees while pushing those firms closer to bankruptcy. And somewhere in a glass tower, a structured finance desk will bundle another pool of leveraged loans into a collateralized loan obligation, slice it into tranches, get it rated AAA by agencies paid to bless it, and sell it to pension funds and insurance companies as a safe investment. This is the shadow banking system, a $65 trillion empire of leverage, complexity, and invisible risk that controls your economic fate while operating beyond democratic oversight or meaningful regulation. It collapsed once in 2008, nearly taking civilization with it. It was bailed out with trillions in taxpayer money. And today, it's larger, more leveraged, and more interconnected than ever before, waiting for the next shock that will reveal how fragile the whole structure really is. The question isn't whether shadow banking will cause the next financial crisis. The question is whether, when it does, there will be governments large enough and willing enough to intervene, or whether we'll finally face the full consequences of building a financial system in the shadows, beyond the reach of laws designed to protect us from the darkness that greed creates. Subscribe and listen to our next story below.